If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our moderator. First, this webinar is being recorded for those that cannot participate in today's live event. If you have any questions for our panelists, please click the Q&A button at the bottom of your Zoom window and type your question. We've allocated sufficient time at the end of the webinar to address your questions. And now I would like to introduce you to our moderator, Dr. Howard Gruenspecht, Senior Energy Economist at the MIT Energy Initiative. Howard, over to you.
All right, thank you, Dave. So clearly the coronavirus pandemic is on everyone's mind for both personal and professional reasons. It certainly has major energy impacts. I think it's fair to say that most attention in the mainstream media and the trade press is focused on implications for short-run balance in oil and natural gas markets and effects on energy demand, electricity demand, and the generation mix. Today's webinar takes a little bit of a different approach. It focuses on the implications of coronavirus and responses to it for personal transportation, including fuel markets, vehicle markets, and travel behavior. Both near-term and longer-term effects will be considered. Possible interactions with other vehicle-related policies, will also be taken into account. So in that area, both the Trump administration recently issued a final rule to relax fuel economy regulations, but other countries that are focused on reducing emissions are going in different directions. Topics for the panel include upstream and downstream issues raised by shifts in transportation fuel demand, as well as vehicle manufacturer plans and policies, including the future role of electric vehicles. So I've asked each of the panelists to take about 10 minutes for opening comments. After all the panelists have provided their opening remarks, we'll turn immediately to discussion and Q&A. You can certainly enter your questions at any time using the Q&A feature of Zoom at the bottom of your screen. So I'll introduce all the panelists up front. I think that'll be the most economical. We have three panelists who are very well equipped to kick off our consideration of these topics. Michael Cohen is the chief U.S. economist and head of oil analysis in BP Group's economics team, with responsibility for global oil and transportation analysis, as well as analysis related to U.S. energy policy. His prior experience include positions at Barclays Bank, the International Energy Agency, and the U.S. Department of Energy. Ellen Hughes-Cromwick is the senior resident fellow at Third Way's Climate and Energy Program. Previously, Ellen was the chief global economist at Ford Motor Company for many years, and she also served as chief economist of the U.S. Department of Commerce during the Obama administration. Ellen is a past president of the National Association of Business Economics, and I think she plays many roles in that organization. Hannah Pitt is a senior analyst with Rhodium Energy and Climate team, where she focuses on analyses of key developments in U.S. and global energy and climate policy, including fuel economy regulation, but certainly way well beyond that. Hannah previously served as a senior policy analyst at the Center for Clean Air Policy, where she focused on the design and implementation of climate mitigation strategies in developing countries. So it's a great panel, and I'm very anxious to hear what they have to say. So let's start with Michael, and then Ellen, and then Hannah, and then interaction. So Michael, the floor is yours.
Thank you, Howard. Just trying to make sure that everybody can see my screen here. Howard, is that?
Yes, I can see it.
Okay. And thank you all for your patience. Thank you to the USAE for hosting me. It's an honor to have such a very well-regarded group of panelists, and I'm excited to hear what they have to say on this subject too. And I think we have to all approach this time that we're in with a certain sense of humility around the uncertainty that we're experiencing, and sort of help provide a little bit of a dose of that humility with any kind of forecast. So with that in mind, I thought I would use my initial time here, 10 minutes, to just sort of set the stage of what we're talking about when we're talking about transportation fuel demand. And to start off here, just look at the transport fuel and overall oil demand effect of these major lockdown measures and contraction in GDP growth. So when we look at how the contraction in oil demand in the second quarter and the expectation for the year looks compared to history, we're looking at a second quarter shock of down to 75 million barrels a day or so. That brings us back to levels in line with 2002 oil demand. And at the same time, for the entire year, if the IEA's forecasts come to fruition, that brings us down to levels that we last saw in 2012. So with 4.5 billion people in confinement through April and at some point during the second quarter, and not consuming oil in some way, shape, or form, that's going to lead to pretty dramatic reductions in transport fuel demand. So I'm using IEA's forecast here. There are others out there from the sell side and from industry and other consultancies. They're all in that general range. GDP growth, this quarter I expected to fall by anywhere to 30 to 40%, the largest fall since World War II. And I think the question that many of us are pondering as we address this issue of transport demand is the idea of what is temporary and what is steady state. And so The Economist came out with an article, I think last week or the week before, suggesting this idea of a 90% economy, one that is more fragile, less innovative, more unfair, similar to the kind of economy that we saw post the Great Depression, where the level of output in the early 1930s was no more than about 92% of the 1929 level. And so I think that's something overarching all of the analysis of transport fuel demand, is the idea that the level of the economy, not just the growth rate, but the level of the economy is something that is structurally lower than where we started. So when we look at what's happening right now in the prompt, the question is, what are the high frequency indicators showing? And I think one of my colleagues is also going to address this, so I'm not going to spend too much time on it. It does show a very, very gradual improvement over the last couple weeks. When we look at the EIA data that is showing the decline in motor gasoline demand and jet fuel demand, both of these, took off for at least gasoline anywhere from 4 to 5 million barrels a day from this sort of steady state level, but a very large shock in percentage terms to jet fuel demand in the United States. And so our indications from rack liftings throughout our network do show some substantial improvement over the course of the last week or two within the US, but by and large, we're still structurally lower than where we were before. And I think refineries have been addressing this by either shifting yields. We saw a very high percentage of diesel. So a lot of that jet fuel that wasn't being needed was being directed back into being produced as other middle distillates, and mainly for diesel. And now that gasoline is starting to rebound, those refineries are going to be shifting again to prioritizing gasoline. So when we think about the question of what does this mean for the long term, I wanted to show these charts, even though they are a little bit dated. They're from our energy outlook that we produced in 2019, just to highlight the share of oil demand that is transport related. So it's these first three bars, so roughly 40 to 50 million barrels a day of oil that is transport related. Most of that demand is, over the course of the longer term out to 2040, was going to be driven by changes in efficiency. And when we look at what that means for the developed world, the developing world, that changes. So for the most part, efficiency gains were meant to be more pronounced in the developed world, whereas the demand for transport, so that need to travel, was driving the overall oil demand in the developing world. And so the efficiency gains that we had expected to see in road transport were much more pronounced than what we saw in other components of liquids consumption. And so what that means, though, is that while transport plays a very large share overall, it's a diminishing share. And for the most part, over the course of time between 2020 to 2040, the growth in oil demand was meant to come mainly from the non-combusted side, so mainly petrochemical products. And some of that oil was bypassing the refining system. And I think that's the main implication for the industry as we move forward, is that when you look at this chart, which breaks out the share of incremental demand by product, much of the way in which you could be providing gasoline and also LPG and naphtha-related products over the longer term were ways in which were bypassing the refining system. On the other hand, the major source of incremental need for refining supply was coming from jet and kerosene incremental demand. So that's the point I want to just make, is that there's a lot of reliance on a rebound and a reversion to that steady state of jet and kerosene demand over the longer term. And if we engage in a period of time, either in the medium term or through the longer term out to 2040, where that jet and aviation related demand is not there, it will create increasing issues for refining profitability over the longer term. The other point I just want to make is, depending on the assumptions that you make around your emissions pathway, your energy efficiency assumptions, your demand for travel, so your income, you get a very wide range of oil demand scenarios. And so while this is last year's outlook that the BP produced, what's going on right now, and we are not alone in this, many forecasters are struggling and trying to figure out how to address this over the longer term. We have to look at those technology assumptions, the efficiency assumptions, policy assumptions, and figure out how does that make this scenario look different going forward. So to conclude, I wanted to look at this last slide here and try to suggest a couple different talking points that I'm sure that my co-panelists will pick up on as well. So I think we have to break the analytical question into very short term, so now to the end of the year, to medium to long term, when the vaccine is likely to be available. And so for the short term, the next 12 to 18 months, I think that there are a couple different aspects of the question that we should be thinking about. Number one, the load factor. So the number of people that are willing to be in one car. On average, that's going to decline in the short term compared to where we were before, partly as a result of the aversion. And in the same way, it's the aversion to public transit. And I would say, sorry. Second, close Teams out. There we go. Apologies for that. So again, short term, load factors, public transit aversion, obviously that will increase congestion. Some of what we're seeing right now in China that is going to reduce the average number of passengers in a vehicle from, let's say, 2 to maybe mid 1.5, 1.6. So that in turn results in a maybe 15 to 20% increase in the vehicle miles traveled if the passenger miles remain the same. So that's something that is obviously going to have a big impact on road fuel consumption. As well, I think there are going to be different cohorts of the population by age that are going to be more at risk from the coronavirus and may express more unwillingness to get back into cars. You know, the chart on the right here is showing the share of the vehicle miles traveled by purpose. So you can see that 25% of the vehicle miles traveled were related to school, church, other social recreational activities. The work-related component, commuting, 20%. So obviously the issue of what is the rebound from employment, from the economic backdrop, how much that affects the number of people that need to go back in. And then of course the other question, even in the short term, as we all work from home, is how permanent will that be? I think at the end of the short-term time frame, there's going to be a lot of pent-up demand for leisure or holiday travel. Maybe that's via different modes. Maybe that leads to higher levels of passenger transport. But when we think about the time frame beyond that, you know, you have to start considering these questions of scrappage rate. You know, do the more inefficient cars stay on the road longer? We have to think about the chart on the left, which shows some level of fuel price elasticity, how that affects fuel economy per passenger miles, an open question. What the chart shows is it tends to be that when prices are below that $40 per barrel range, you tend to dent your miles per gallon by 0.2 to 0.8, you know, based on what we see from the sales weighted fuel averages, just because people are buying more SUVs and trucks and light trucks. So I'm sure that my panelists will comment on that as well. The other thing to think about is a reshoring, you know, the deglobalization trend. To what extent does that lead to more commercial activity on, you know, within a particular country in an inefficient way than what may have been happening before? You know, the extent of use of e-commerce. I'm sure others that have views on that. But I think the real interesting thing for transport demand comes down to this question of what is the percentage of the US population that is able to work from home. You know, the statistics showed that something like 15% of the population was able to work from home. And of that 15%, there was 15% that actually did work from home roughly 5 days every month. So depending on how you shock both of those assumptions, the number of, you know, namely, first of all, the number of people that can work from home, the number of people that actually did work from home, and the number of days they are working from home, you get very different outcomes in terms of fuel savings. So, you know, there's numbers that we've thrown around that range from 1 to 3 million barrels a day globally, taking those assumptions. And I think there's a lot of risk taking those US-based assumptions and making any kind of conclusions around what the rest of the world might do. So with that, I hope that I've just at least shared with you some of the questions that we're pondering, maybe not given any concrete answers, but at least is a good stage for further discussion with all of you. So I'll stop
Thank you,
there.
Michael. That's great. I think it really sets the stage. Ellen, love to hear from you.
Okay, great. I'm going to pull up my slides and hopefully you'll be able to see these. And let's do my slide.
We do.
Great.
Electric vehicles.
Yes, and you know, I'm going to pivot a little bit from Michael's introduction to talk about two issues which are front of mind from my perspective about transportation. And that is, number one, does COVID and the ensuing recession lead to any setback in terms of this electric vehicle trend? That's point one. And then point two, given the fuel economy regulation adjustments, is there any there? You know, are companies like my former company, Ford Motor Company, are they going to be changing their product development strategy as a result of these adjustments to fuel economy? Let me first say that I think that this transition to electric vehicles, or EVs, and by that I mean plug-in electric and battery electric, that transition is persistent. Number one, the battery costs are coming down substantially, and I'll show you a chart on that in a minute. That trend in the technology advances are really following Moore's law. We're seeing unit cost reductions and now innovation that's going to set up the next generation of batteries that are fundamentally solid state and more abundant raw materials. That's a critical tech development. I do think too that number two here, that there is a move for grid integration services and a host of options that will allow the battery to be a storage medium for the grid over time. I mean, there is a lot of energy going, figuratively, energy moving into this area of grid integration services, and automotive companies, laboratories working with utilities to make the battery a storage medium. For example, Argonne National Lab is now launching their supercomputer to do AI in order to understand the repurposing of batteries and recycling of batteries. And that efficiency tech will be really essentially put in the public domain for anybody, any company to use. That's going to be a big thrust, I think. Number three, I mentioned decarbonization. There are a lot of market forces underway. I mentioned a few here, but let me also add to this. I was on a panel this morning in London, virtually, and we were talking about how the capital markets are moving into this area. And for example, many companies are becoming members of the task force for climate-related financial disclosure. And what that means is we're moving towards standard approaches to how we quantify climate risk on corporate balance sheets. And investors, you know, they're going to vote with their feet. They're looking for opportunity and value in assets that are going to offer up decarbonization over time. They see that really crystal clear as a long-term trend. And therefore, I'll answer your question on the bottom line is that I don't think COVID, the oil price collapse, or any adjustment in fuel economy regs is going to derail that transition. Just quickly, on the left panel of this slide, you'll see battery pack costs adjusted for inflation. And this is the dollars per kilowatt hour measure. Many of you probably know that the Department of Energy has indicated that getting pack costs to $100 or below is really the tipping point in terms of its competitive cost structure relative to conventional gasoline-powered vehicles. And here you see the Bloomberg New Energy Finance Survey results. Last year at 156, projection at 100 by 2025. My network has clearly shown that we already have companies that are putting packs together at that $100 threshold. This is likely to continue this trend, especially as we move to next generation solid state batteries. On the right panel, you'll see the data for 2018 and 2019 for EV sales. And again, just to emphasize, we're moving toward EVs for a number of reasons. One is the economics. Number two is the climate factor, which is becoming more important for companies and for capital markets. And number three, if I'm an automotive company in the US and I want to sell in Europe or I want to sell in China, I'm a global company. I can't just make one vehicle for one market, make a different vehicle for another market, and be profitable over time. Therefore, there is a drive toward commonality of the platform. And many of you know that a battery platform, you know, is a very efficient chassis for a vehicle, less complex. The torque is great. If any of you have ever seen the electric Formula One races in Brooklyn, you'll know that the performance of these electric vehicles are incredible. So in other words, there's a market and a business reason that will continue this trend toward EVs. And then finally, I just want to end with, you know, what's happening in the capital markets. We've had a lot of announcements recently among companies to get to net zero emissions by 2050. Let me mention in the automotive sector, since transportation is the largest contributor to CO2 emissions, that my simple scenario when I forecast out scrappage and look at VMT and so forth is we have to get to 100% EV sales by 2035 if we want to get to net zero emissions by 2050. That sounds incredibly ambitious, but I do think more and more as companies commit to zero emissions by 2050, they're going to back out that result. And if the cost structure keeps coming down, they'll be able to achieve that flipping. I mentioned the task force for climate-related financial disclosure, the network for greening the financial system. That is essentially nearly all of the major global central banks have signed up to this in order to assess what climate risks are on company balance sheets. And I will mention that catastrophic modeling done by insurance companies and pension funds and so forth are already estimating what the impact is associated with climate change, and they're able to offer up green bonds and other financial products that help mitigate that risk. The broader investment community, pension funds, endowments are now moving toward asset allocating for green-related investment products. The green bond market last year was about almost $300 billion. Admittedly, that's small as compared to the global bond market, but it's growing very substantially. So I'm going to leave you with that and turn it back over to Howard. Thank you.
Okay, thank you very much. Now I'd like to turn to Hannah Pitt and then to the open conversation. Hannah?
All right, let me get my presentation going.
Fuel economy in the time of COVID.
Okay. Can everyone see my screen?
Yep.
Great. So just briefly for those of you who might not be familiar with the Rhodium Group, we're an independent, nonpartisan research firm focused on climate and energy policy and climate risk analysis. So I'm going to talk a little bit about fuel economy in the time of COVID. Some of this will involve analysis that the Rhodium Group has done in the past couple of years, looking at fuel economy, in particular, the proposed rollbacks of the Obama era fuel economy standards by the Trump administration. But then I'm going to talk about how much of what we thought we knew about fuel economy is thrown into question given the crisis, the COVID crisis, and that part will be more questions than answers. So this is our pre-COVID analysis of CAFE rollback scenarios. So in the past few years, we have looked at a number of different proposals on the table. So the Obama era CAFE standards that are under threat by the Trump administration promised to deliver roughly a 5% annual improvement on fuel economy through 2025. You'll see here, this is fleet-wide fuel economy for passenger vehicles, and the Obama standards clearly achieve the highest level of efficiency by 2030. The worst is the CAFE freeze. So these are the rules originally proposed by the Trump administration that would have frozen CAFE standards at 2020 levels. In more recent months, the administration has put forward a rule that would deliver a 1.5% improvement annually. That's the orange line. It does only slightly better than just freezing CAFE standards. And then the California deal, while all this has been going on, California has been working with a subset of automakers who have agreed to voluntarily meet higher standards. So this is modeling that subset of automakers achieving higher standards, and the rest of the auto industry adhering only to lower Trump proposal standards, and that does slightly better than just the 1.5 current rule. I will say that if scaled up to all automakers, the California deal fares pretty much as well as the Obama CAFE standards do. So in terms of emission abatement, as Ellen mentioned, transportation is the largest source of greenhouse gas emissions in the US. The 1.5% proposal annual improvement rule currently would deliver, we expect, 143 million metric tons of abatement relative to no standards through 2025. That's only about a fifth of what we would expect under the Obama era standards. And that's actually a pretty big deal. The difference between those two is equivalent to the annual economy-wide emissions of more than 70% of countries worldwide. It's the biggest proposed rollback of the Trump administration yet. So now, of course, maybe we need to throw a lot of this out the window because COVID, like so much else, has really turned the picture upside down. No sector in the energy space has been more impacted than transportation, as personal travel has ground to a halt, as the airline industry has suffered enormously, and this is weekly petroleum demand year on year. And you can see that in the worst part of the lockdowns a few weeks back, we saw some very deep cuts in petroleum demand, particularly from jet fuel. That was about a 77% year-on-year reduction. From gasoline, it's about a 55%, and from diesel, about 27%. Altogether, the cut in petroleum demand was about 2 times larger than the worst week that we saw in the 2008 recession. And what's different about the lockdown is that we saw the deepest cuts in gasoline and diesel. So really people not driving, not flying, and a less impact on diesel. We saw diesel taking a much larger hit in the previous recession, which was, of course, economically driven, whereas this is really the result of a shutdown. In terms of auto markets, vehicle sales have really fallen off a cliff. April saw a 50% year-on-year reduction in vehicle sales in the United States. This means that people are likely to be holding on to their cars. If the lockdown and the recession that follows is really putting a hold constraint on household spending, then they're unlikely to make large purchases, may put off buying a new vehicle for some time. Even in the best of times, folks tend to optimize on sticker price and not fuel savings. And so that could have a further hit to fuel economy. On the other hand, smaller cars tend to be cheaper cars. And if and when people do decide to buy, they might be looking to buy a smaller vehicle and sort of put off buying that Hummer that they've been thinking about. So impacts on fuel economy yet to be seen. The other indicator that my colleagues have already mentioned are oil prices. So those have also fallen off a cliff, as you all know. And all else being equal, people buy bigger cars, at least Americans buy bigger cars when prices at the pump are lower. So in 2012, about 50% of new sales of passenger vehicles were light trucks, and more recently that number has shot up to about 2/3 of all new sales are light trucks, in part because of low oil prices we've seen in past years. Of course, not all else is equal, and so it's yet to be seen, how long these low oil prices persist and how that interacts with some of the income effects we're seeing as folks are pinched in terms of buying new cars. It'll also be interesting to see how these oil prices, what they mean for the electric vehicle market. I certainly hope my colleague Ellen is right that the electric vehicle battery price cost reductions will continue to drive new electric vehicle sales going forward. But it's yet to be seen exactly how both consumers will react to the economic crisis, and coupled with low oil prices to in terms of their appetite for purchasing new electric vehicles, as well as how automakers will react. Of course, there are some good signs. I believe Ford has announced it's going to be holding up. It intends to meet all of its targets in terms of EV production sales. So a lot of uncertainty there. Two more wild cards, and this is not an exhaustive list, that I don't have slides on, but I wanted to mention are behavior change and policy. So on behavior, some of this Michael mentioned, there's a lot of uncertainty about how much companies will shift to remote work, how much that would even impact overall demand for travel, how much folks are going to be afraid to use public transport and shifting into using their private vehicle more for fear of contracting the disease. So a lot of different potential long-term behavioral change. And I think that will depend in large part on sort of the duration and potential recurrence of the kind of lockdown we're in now. I think early on, a lot of people were talking about a sort of V-shaped recovery. And I think it's yet to be seen whether as we open up the economy, we will see a resurgence in outbreaks and then a lockdown again. And that kind of longer term uncertainty and in and out of stay-at-home orders and things like that could lead to some deeper behavioral shifts, potentially encouraging more and more people to work from home, for instance. And then on the policy side, there's a lot of uncertainty right now about how states are going to react given the budget crunches they're in terms of funding for incentive programs, their appetite for, more stringent regulation on the fuel economy front, for instance, as they're trying to deal with the larger sort of economic downturn and budget crises state by state. And then on the federal level, Of course, there's an opportunity with additional federal stimulus packages for the government to support, public transportation, electric vehicle infrastructure, tax credits, things like that, that could encourage and spur more fuel efficient and zero emission vehicles. But of course, there's still a lot of unknowns about the scope and the timing, the magnitude of any kind of additional federal stimulus. So, like I said, more questions than answers. I'm going to leave it at that and turn it back to Howard.
All right. Well, thanks to all the speakers. I think they've given us plenty to talk about. I'm looking at the questions coming in, and I guess there is a question about the future of EV sales, electric vehicles. And, some of the data, I guess, that Ellen showed, although Hannah talked about this too, is that EV sales now are a relatively small portion, of total sales. There wasn't great growth at least maybe in the United States, maybe worldwide between 2018 and 2019. And so there's a discussion of, can the ambitious kind of goals that Ellen has talked about, be achieved, and how would they be achieved? So I'd open that to all the panelists, maybe starting with Ellen.
Great. And what I did was I threw that out into the pond, and I'm going to reel it in the following sense. I want to pick up on what Hannah was saying, and to get to a rapid acceleration in the EV platforms globally, that will require policy incentives. For example, we're seeing that in China. They just recently extended their EV subsidies for another 2 years. They are clearly moving toward ensuring that they can develop an electrified vehicle architecture market over this next 10 years. And I'm sure you all know what Europe is doing with regard to CO2 regulations. In the first quarter of this year, EV sales in Europe had a market share that almost reached 7%. And this is at the beginning of this move toward the 95 grams per kilometer regulation. That's moving in place. And here in the US, we continue to see investment flowing into the battery market, but also for EVs. In a very short period of time, Tesla captured 1/3 of the luxury market share.
Right.
And for anybody who's worked in the industry, we would have said, there's no way, no how a brand new company can come in and grab that kind of market share in such a short period of time. I mean,
Okay.
They're going to have half of the market share in the luxury segment very soon. And then now we have Rivian, who's going to be launching an electric pickup truck. So the market can change very rapidly. And people, their behavior, again, if there's support with some policy stimulus, maybe we get another scrappage program, or we get more incentives for point of sale purchase. All of that can move toward a higher EV market share over time.
Okay. So Michael, Hannah, do you have any further on that? Because that's a pretty important question.
I mean, I would agree with a lot of what Ellen has said and what she presented. I think that there's a clear technological cost driver here. The number of different vehicles that are being offered to address some of the mode, the aversion for different groups of people and purposes. I think a lot of that will play out over the very short term, in the next 1 to 2 years. And this doesn't really, even though this is dramatic, this doesn't really arrest that.
Got it.
So,
Hannah?
yeah.
Yeah.
Yeah, I don't have a lot more to add. I think I agree that
Okay.
I think the short-term impacts might be, I think it's more of a question of short-term impacts, the COVID crisis, but in the longer term, I think the trends are in place. I think my biggest worry
Right.
would be the sort of policy, the strength of the policy that we need to be put in place now in order to meet those long-term goals might be set back, at least by some years, given the
Right.
crisis.
So I'm seeing, and also seeing in some of the questions, there's an issue of how the stimulus kind of opportunity there, some people would view it as an opportunity, weighs off against the general sort of tightening of budgets over a period of time, which I think Hannah mentioned, and how that plays out is the question. There's a question here about, I guess, a balance in fuel markets related to somehow, because I guess jet fuel has taken the biggest hit and expected to, maybe be a persistent hit for at least some period of time. And jet sort of sits next to diesel in the distillation tower. Do you think that has any implications for, diesel fuel pricing and potential knock-on effects into vehicles? Just a short answer, Michael, but
Yeah,
I
I
think
don't,
it's
I
important.
think by and large, vehicle sales generally are determined by, the product. I would not say they're generated by product availability or product price. It's the regulation, and I think Dieselgate remains a pretty big driver. Even in 2019, we saw diesel share of sales in Europe decline versus gasoline, and I think that's a trend that, sure, it may slow a little bit, but it's not going to change dramatically.
Got it. What about the financial condition of the vehicle makers? Something that, people, I guess the panel hasn't commented on as a factor driving their ability to make some of the changes that have been discussed. Hannah, do you want to start? I mean, I know that some projects have been delayed, for instance, related to clean vehicles. But again, I think at a high level, the commitment is still there.
Yeah, I mean, I think as if automakers begin to really feel the squeeze, I think it just, honestly, we have to wait and see to, what it is that they cut. If they consider electric vehicles part of their survival mode, then they're going to stick with it. And if they really see them as part of their future business plan, then I think those companies will tend to keep their electric vehicle production plans in order. But we might see some, I think that it's more of like the bringing new models onto the market that might appeal to a broader range of consumers might be harder right now versus sort of the more high-end luxury models that have, their consumer base is probably going to be inclined to keep buying those models even in these economically difficult times.
Great.
Probably not as constrained by the turn down.
So Ellen raises the global, factor. That it's sort of I'll call it a 90 million vehicle market roughly for light duty vehicles around the world, of which the U.S. is maybe 17 million. So that decisions are made based on other things, which certainly may be right. But I also know that in certain classes of vehicles, the U.S. market is much bigger picture in the global world. So like sport utility vehicles, the U.S. Is a very big market. Passenger sedans, not so much. And I'm wondering, rather than presenting this as sort of black and white, is it more gray? I mean, anybody can, yes.
I guess I would respond to that. It's interesting when you go to China and you look at what the either national owned or the private OEMs are doing. They're moving to a car platform, but a crossover SUV top hat. And it's a very popular structure for Chinese buyers. They love that American styling. And you go, you know, you look at WM Motor Group, for example, or NEO, they're all moving, gravitating toward that. Chairman Lee, who heads up Geely, you may be aware, they purchased Volvo, and they've made, obviously, an EV commitment globally. You know, a lot of the issue about car versus SUV has really changed. I mean, an SUV is on a car platform. It's just a different top hat than a typical sedan. So I don't really see that segmentation as distinct anymore as compared to the old days where, yeah, a car was a car and then the Ford Explorer was a truck.
Got it. Okay. So Michael, I mean, you presented some very interesting information, you know, about the oil that doesn't go into a refinery, so to speak. And I've been very interested in that for a long time. You know, is the implication of that work, and clearly the natural gas liquids are becoming very important, and those are classified as oil products when they're sold, or petroleum. And my question is, you know, this question of peak oil that has come up in the past, first peak oil supply, but more recently peak oil demand. And now the question is, if you're looking at just crude oil, the stuff that does go through a refinery, you know, is the implication of some of these changes that maybe we've already seen peak, if not peak oil, have we seen peak crude oil?
Yeah, it's certainly possible. I mean, I will echo what my CEO said in the Financial Times a day
Always
ago,
wise.
and not diverge from that, and say, you know, stay tuned for the updated energy outlook in September. But I think, you know, to your question, and consistent with the prior analysis that we completed last year, that is clearly the case, that the business case for refining over the longer term in a world where jet fuel is not growing, if that is the world we are living in, you know, it's clearly much less. And it means that simple refineries without tidal access are going to be the first ones to see, you know, closure. And that's I think the world that we're facing. I think the thing to keep in mind as well, that I've been thinking about a lot, just because we're in the middle of preparing our statistical review for publication in June. I'm responsible for this first year for biofuels. It's amazing to see how many countries had planned expanded biofuels mandates over the course of this coming year. And because of the relative decline in the attractiveness of using biofuels versus food, you're seeing a lot of closure from those plants, and a lot of walking back of those biofuels targets. So in the short term, I think it's not a good story for biofuels, because that supply will not be there, and those targets will have to be pushed back. And there's not really been much analysis that I've seen on that issue. But I think it's significant.
Very good. So Hannah, I noticed your chart on the California and the Obama standards and the 1.5. And just to clarify, the California was just the California applied to those vehicle makers who've signed up for it. And
that's right.
My question would be,
my slides were not showing fully, but
okay.
Hopefully you can still see them. Yeah, so we did that analysis when California first made the deal with the original 4 automakers that signed on. So since then, Volvo has also agreed to participate. Right. And so the assumption was that the rest of the market was adhering to Trump's proposed rollback,
which was the freeze.
Yeah.
Right. So the combination of the current thing, the 1.5 and the California taken together would, I guess, be a higher line than the California in your graphic?
So yeah, I mean, if we redid the analysis now, that California line would be higher, given that there's an additional automaker involved now, and that the rest of the automakers would be adhering to a 1.5% annual improvement as opposed to a freeze.
Okay, and why? I mean, another related question is why? You know, at the time the California deal was made, I guess some of the things I was seeing suggested that it was reflected a significant cut, so to speak, from the Obama line if everybody would in fact do the California deal, which I guess is what California had hoped.
Mm-hmm.
And I guess your analysis suggests that the California, if it were applied universally, is just about the same as the Obama?
That is what we found. It wasn't, I don't have the numbers in front of me, but it
no.
wasn't quite as robust, but it got most of the way there.
Okay.
And it, you know, I think that it might have to do with assumptions that folks are making around how the EV credits are used and things like that. But according to our, you know, trying to do like apples to apples comparison across all the standards, we find that it both in terms of miles per gallon and the, you know, cumulative abatement numbers, they get very close to Obama.
All right, very interesting. So does anyone have a last comment they would like to make? All right. Well, then let me end by thanking the panelists. I think they were great and thoughtful presentations. And I think they all point to the big factor that there's just a lot we don't know, but there are systematic ways to think about what we don't know in terms of both the vehicle markets and the fuels markets. And I think all the panelists and probably all the audience will be working on those issues, you know, in the coming months and maybe the coming years. So with that, I think I should turn it back to Dave and thank everyone, both the panelists and the audience. Dave?
Yes. Thank you, Howard, and thank you to our distinguished panelists. This was an outstanding webinar. I'm very, very grateful for all of your participation. I know I personally have learned quite a bit. You know, the landscape is changing so much and will be so more as we move forward. So again, very, very grateful for all your time. For all of our listeners, this webinar has been recorded. It will be available for download on our website. It should be up within the coming hours. If you're not already a member of the association, we do welcome you to join. Check us out at www.usae.org. Thank you once again for attending, and I officially close this webinar.